Hey Bowtie Nation, Joseph Hogue here with an update to our 2020 dividend stocks portfolio and 3 stocks I'm buying in August. And Nation, I'm excited about buying these stocks because they're in part of a market that is possibly the best undiscovered opportunity right now. If you've been following those bank stocks, the second quarter was not good at all. I'll show you just how bad it later, but the Fed hit the entire sector with its stress test and then changing the rules on what they can pay out as dividends. But there is a huge disconnect here between the bank stocks and the rest of the market, something I think could come through as an upside surprise as early as the fourth quarter and then add to those dividend yields. I'll be putting these stocks in my portfolio on M1 Finance, and I love the platform for that automatic investing and rebalancing function. I can put in my percentage of the money I want in each stock or fund. The website is going to automatically invest any new money across that group. M1 is totally free to use and offers some great savings rate and other features. I'll leave a link in the video description below, so make sure you check that out. So let's look at that 2020 dividend portfolio, but I want to send one last shout out to all you in the nation. Thank you for spending a part of your day to be here. If you're not part of the community yet, just click that little red subscribe button. It's free and you'll never miss an episode. I'm only going to recap the dividend portfolio this month because I want to get to those 3 dividend stocks to buy and the hidden opportunity in this part of the market. Here we are on my M1 Finance account and about a 5% return on the portfolio, which is about double the 2020 return on the S&P 500 so far this year. We've had some great dividend stock picks. This Vanguard Real Estate Fund, the VNQ, is one of my favorites. Actually a holdover from last year's portfolio, so not all of that 54% return is from this year. We added shares of AIG a few months ago, already a 27% return, and this is one of the 5 highest return favorites among Wall Street analysts, so I still like this one along with that solid 4.3% dividend. We added more of this global medical REIT, ticker GMRE, last month to give us a little more exposure to healthcare and the real estate space, and its 6.9% yield. These next 3 are all income funds we added for diversification, really a great way to get access to some of those income-producing assets outside of stocks. But if we scroll down, it hasn't all been rainbows and unicorns. We added Carnival in January at about the worst possible time. Towards the end of last year, the world's largest cruise operator was looking as a great deal, but we know how that turned out. I like it as a hold here, but we're not adding to this position. These others at the bottom here are all from those January and February dividend picks, so still hurting from that sell-off, but I still like the companies. So that's where the portfolio stands heading into August, and not bad with a 5% return so far this year. But now I want to show you the dividend stocks that we'll be adding to this month because I think this could be one of the biggest opportunities in the markets for dividends and returns over the next year. I'll put this video in our 2020 dividend stocks playlist so you can check back on some of those prior videos to see the stocks that we've added in prior months. Now, if we look at profits for the last quarter, we know that financials were just god-awful. Shares of financial companies in the S&P 500 reported earnings 53% lower than they were last year. This is a chart from FactSet Earnings Insight showing the earnings reported for each sector, and every sector got hit hard, but a few of those really stand out as losers. From the right, we see energy companies reported an unbelievable 165% drop in profits. Most earnings were deep in negative territory for these energy companies. Industrials and consumer discretionary stocks, so those retailers, they both did abjectly horrible. And then we see the financials here, so banks, insurance companies, and others in that sector. In fact, the financials reported the 4th largest decline of all 11 sectors in the economy, and banks were even worse off, reporting profits were 77% lower than last year's quarter. Stocks of financial companies are down 22% so far this year compared to a 2.5% gain on the S&P 500 and a 24% run in tech stocks. But here's where we get to that hidden opportunity in this sector, the disconnect that nobody is watching. One thing that's really interesting is that while financials reported one of their worst earnings declines, it was the 3rd best of the 11 sectors in revenue. Here's a chart of the revenue growth over the last quarter, and again, it was pretty bad for everyone. The only 2 sectors to report profits grew compared to last year were IT and healthcare, the 2 here on the far left, and that was only growth of 3.7% and 2%, so nothing spectacular. But look at the financial sector here, 3rd from the left. Even though companies in the sector reported profits, so that's earnings that were nearly the worst in the market, revenue fell less than 0.5%. Sales of financial companies were down just 0.4% from last year's second quarter compared to the rest of the market that reported an average 10% drop in revenue for the period. So revenue, that's the top line sales number, was actually fine, but something in between sales and earnings just fell off the cliff. And in fact, we know it was the loan loss provisions. Now, loan loss provisions are the safety net that banks make when the economy looks weaker. Basically, the banks try to estimate how bad the economy could get and how many of its loans could go into default. It then sets aside a certain amount of money as a cash cushion just in case those loan defaults do start to increase. The way it does this is the bank is going to take some of that money out of what would be its earnings and put it into a separate account, this loan loss provision account. Now, that's what we saw in those first 2 quarters of the year with these bank stocks. They did relatively well on the revenue side, so those sales, but they're taking so much money and putting it into these safety net accounts, these loan loss provision accounts, that there's just nothing left when you get down to earnings. Of the 4 largest banks, Wells Fargo, Bank of America, Citigroup, and JP Morgan, this loan loss provision account has exploded to $24.6 billion, up almost 400% from just $5.2 billion in the last quarter of 2019. Just these 4 banks are sitting on $24 billion in cash in that what-if account. In fact, among the 17 largest banks with more than $100 billion in assets, reserves represented 32% of the projected loan losses over the next 2 years. These banks have set aside enough money to cover nearly a third of all their loan losses over the next 2 years, and that's in the worst case scenario for defaults, the severely adverse scenario in the most recent Fed stress test for banks. So nation, there is a huge disconnect in the market right now. Everything else, all the other sectors are priced as if the economy is going to come bouncing back. Analysts expect the economy to come rushing back next year for a 29% increase in earnings of S&P 500 companies, while the financials are expected to do even better, reporting a 32% increase in earnings. In fact, we see here in the earnings estimates for next year, only companies in the consumer discretionary and industrial sectors are expected to post stronger profit growth. If we look at the estimate for the entire market, here in the chart of annual earnings for companies in the S&P 500 from 2010 through 2021, analysts expect this year's earnings to be rough with a 21% drop in profits. But the stock market is forward-looking, and the fact that Wall Street sees profits bouncing back to $164, just above where they were last year, that's why stocks are doing so well. Again here, the overall market is up 2.5% from the beginning of the year, but if you look at those bank stocks, they're down 22%. Bank stocks are still trading like the sky is falling, and they can't both be right. If the economy doesn't fall apart, if we get anywhere near those earnings estimates for the S&P 500 next year, then banks aren't going to be seeing that wave of defaults that they're predicting. That means tens of billions of dollars are sitting in those cushion accounts. Those loan loss provisions are just sitting there and aren't going to be needed. So do you start to see what I'm getting at here? Okay, just like taking that money out to put into those loan loss provisions caused bank earnings to be just horrible. When they realize that those loans aren't going to go into default and they move that money back into the income statement, earnings are going to surge higher and it surprise the market. And with as much money as the government and the Federal Reserve is pumping into this economy, it's hard to see how we get anything more than a mild recession. Between the Fed and the fiscal stimulus, we've already seen $10 trillion pumped into the economy and probably more coming on the way. Interest rates are so low that companies can basically borrow for free, so I just don't see how we get that wave of loan defaults the banks are saving against. Even if we do get an uptick in loan losses, though, these bank stocks that we'll look at are some of the best value plays in the market and produce solid dividends to wait for that return. So for our 3 dividend stocks to buy in August, I've put together 3 with some of the lowest price-to-book values in the bank stocks. Banks with loan loss provisions that could reverse for huge profits and a surprise upside. We'll start off with the best value in bank stocks, Citizens Financial, ticker CFG, and a 6.4% dividend yield. Citizens is a smaller regional bank operating mostly in the New England states, Mid-Atlantic, and the Midwest. Now, the virus hit the Northeast really hard, but has come under control there, and the Midwest has done fairly well also. That leads me to believe that the economic hit won't be as bad there, and the bank should do really well. Against that optimistic outlook, Citizens has doubled its loan loss provision to $2.4 billion over the last 2 quarters. We'll look at the balance sheet for each of the bank stocks, and you can find how much they put in these loan loss provisions, that loan loss allowances down here in assets. See here that Citizens has increased that cash cushion from about $1.2 billion last year to over $2.4 billion in the most recent quarter. Now that $1.2 billion taken out of earnings has meant a scary plunge there to just 3 cents in the first quarter and 53 cents per share last quarter. The company is expected to grow earnings by 51% next year to $2.55 per share, but there is a very good chance that they could do even better than that. Shares of Citizens Financial are trading for just 0.52 times the book value of assets, and the stock has a history of trading around 0.8 times book value, so we're looking at potentially at a 35% discount on the share price along with that dividend. Analysts here have price targets on the shares from $25 each at the low end, right around where the stock is trading now, to as high as $34 per share over the next year. New York Community Bancorp, ticker NYCB, is an even smaller bank, but still sports a 6.6% dividend yield and some safety in the theme. Now again, since the region worked through the virus fairly quickly, we didn't see the numbers come down quite as hard for NYCB. Shares are down only 15% from the beginning of the year, and earnings didn't take much of a hit. In fact, New York Community was one of the very few banks to report an increase in profits in the second quarter. As a result, the bank hasn't shifted much to that loan loss allowances here. It increased it to just $162 million from the last year's $149 million, but that's still $13 million of earnings that could come back to shareholders over the next year or two. Shares trade for 0.81 times book value, about a 15% discount to the longer-term average, and the dividend yield here is rock solid. Since earnings haven't come down, there's no danger of that dividend cut like we've seen in those other bank stocks. Analysts are also bullish on the shares, with a low target around $10.50 a share and a high of $14 each over the next year. We've talked about Wells Fargo, ticker WFC, on the channel before, and I'm finally putting it into our dividend portfolio. Now, a 1.7% dividend yield wouldn't normally qualify as a dividend stock in my book, but this one just got cut, and I think the worst is over for investors. The bank has put nearly $10 billion into its loan loss provisions, above what it normally holds, and had to cut that dividend to protect cash flow. But I don't think it's going to be long before Wells Fargo pushes that dividend back up, and this is one of the best values in banking. Shares are down 55% from the beginning of the year and trade for a price-to-book value of just 0.63 times. And while I'd say a price-to-book of 1.0 is a pretty good target for most bank stocks, Wells has historically traded above that, around 1.2 times book value. So we're talking potentially double that share price if the stock gets back to that normal trading range. Earnings have been nasty over the last few quarters as the bank pushes more of that money into those loan loss provisions, but profits are expected to rebound to $2.10 per share over the next year. That would still be about half of what they were last year, but a huge improvement. Wells is the leader in U.S. mortgages, and that side of the market really hasn't been hit quite as hard. I don't see them needing nearly $20 billion in loan loss reserves, and I think the stock price takes a big jump early next year when that dividend is restated. There's a wider range of estimates than we saw in those other two stocks. Analysts have targets of just under $21 at the low end to as high as $40 per share over the next year. Now, what I'm looking at here is when that dividend does get increased, eventually back up to the $2.04 per share where it was before the cut, that's a dividend yield of over 8% for investors that buy in at this price. Click on the video to the right for the 7 highest paying monthly dividend stocks. 7 great dividend payers that will put cash in your pocket every single month. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.